You've spent decades building your retirement accounts, but here's a question most people can't answer. Do you actually know who gets that money when you die? Not who your estate plan says, because the IRS doesn't care about your estate plan or your will. Your 401 and your IRA go to whoever is named on the beneficiary form, period. Even if it's an ex-spouse, even if your will or estate plan says something completely different. And if your family inherits it the wrong way, they could lose a third of it to taxes inside of 10 years. So today, I'm going to show you exactly how to make sure that doesn't happen. Hi, I'm Andrew Rafal, founder of Bayntree Wealth Advisors, and we've spent decades helping high-income earners and business owners protect and transfer their wealth as efficiently as possible. So let's get into it. Here's the mistake we see constantly. Someone passes away. The family goes to settle the estate, and the retirement accounts go to the wrong person because the beneficiary form was never updated. A divorce happened, a child was born, a parent passed. The account just never got updated. Your will or your carefully drafted estate plan cannot fix this. Beneficiary designations are a contract directly between you and the financial institution. They override everything else. So step one, before anything else, is to grab all your retirement accounts you have and confirm the beneficiary is exactly who you intend it to be. Not who you think it is, who it actually says. Now let's talk about what happens when your heirs actually receive that money, especially IRA money. The rules have changed significantly since 2020. Under current law, most non-spouse beneficiaries, meaning your adult children, siblings, anyone who isn't your husband or wife, have to fully empty the inherited IRA within 10 years. There are, in most cases, no required annual withdrawals, but the account must be zeroed out by the end of year 10. And here's why that matters. If you leave $1 million IRA to your son who's already in his peak earning years, he's pulling that money out and getting taxed on it on top of his own income. He could easily be pushed into the 32nd bracket or the 37% tax bracket on the money that you've already paid taxes on or planned carefully to defer. The account you spent a career building could lose significant portion to taxes inside of this 10 years. That's not hypothetical. That's math. And this is where the type of account you leave makes an enormous difference. A traditional IRA or 401 passes to your heirs with a tax bill attached to it. Every dollar they pull out is ordinary income. Now, a Roth IRA will pass tax-free. Your heirs, though, still have to empty it within the 10 years, but none of those withdrawals are taxable. This is one of the strongest arguments for doing Roth conversions before you pass away, not just for your own retirement, but as a deliberate act of tax planning for the people you're leaving the money to. You pay the tax now at your rate, so they don't pay it later at theirs. One more thing to get right. Some people name a trust as their IRA beneficiary, often with good intentions to control how and when heirs receive the money. But if the trust isn't structured correctly, it can actually accelerate the tax hit and compress distributions into an even shorter window. Trust tax brackets are also some of the steepest in the tax code. They hit the top rate at just over $15,000 of income. So if a trust is part of your plan, make sure your estate attorney or your financial advisor together have reviewed it. This is not a set it and forget it document. Very, very important there. And here's what to do right now. Pull every retirement account, verify those beneficiary designations. Don't assume, confirm. Think about whether your heirs will receive traditional or Roth accounts and what the tax difference actually means for them. If you have significant IRA account balances, talk to your advisor about whether Roth conversions make sense as a legacy strategy. And if a trust is involved, get your attorney in the same conversation. And if you're not sure how your retirement accounts are structured or whether your family is set up to receive them efficiently, take a look at our free Retirement Readiness Assessment. It takes less than a minute, and it gives you a high-level view of your retirement readiness across income, investments, taxes, healthcare, just overall planning. And it will give you a clear picture across what that means for you. The link is in the description below. And remember to subscribe for our weekly retirement planning insights. We're going to see you in the next video. Thanks for watching. Happy planning, everyone.